Good afternoon, everyone. My name is Aron Betru. I'm the Managing Director for the Center for Financial Markets. And to provide a little bit of context, the Center for Financial Markets is the group within the Milken Institute that's pretty much the nerve center with regards to pushing for financial market understanding, evidence-based research to promote effectively deeper, more efficient, wider capital markets, promoting innovative financing to address global challenges. And we're going to be discussing one of those today with regards to financial inclusion. FinClusion. I gotta love these titles. Connecting the unconnected.
FinClusion, right?
I apologize, you're right. We're in a millennial environment. What that means is we're talking about the roughly 2 billion individuals around the world that do not have access to lending, savings, insurance products, an essential element to grow their enterprises, their community resources, the economies at the country level. Make no mistake, this is not necessarily just talking about financial products. This is an essential element in society. If we all believe that it's rather important to help someone not give them fish, but give them the tools to learn how to fish, what we're talking about is the means to acquire that rod, the net, and everything in between to not just prosper, but to survive. Look at what's going on both sides of the pond today. There are a number of communities that feel disconnected, not having the same access to resources to grow. And financial inclusion is a critical element in all of that. So what we're going to discuss today is a number of different things, to everything from really unpacking the situation of financial exclusion, its root causes, its impact on society. We're going to talk a little about the activities going on from the public sector, the private sector, and everything in between, and things that might actually be transferable lessons to all of us in the audience. And so with that being said, allow me to introduce some of the luminaries that we're going to be helping us understand what's going on out there. And starting on the extreme right of the audience, we have Bob Annabelle, Global Director for Community Development and City Inclusive Finance, Tillman Erbeck with Omidyar Network, and Susan Lund here, a partner at McKinsey Global Institute, Daniel Gorfine, an adjunct fellow within the Milken Institute, but in his day job is also the Vice President, External Affairs, Associate General Counsel at On Deck. And then on the end, we have Shamina Singh, President, MasterCard Center for Inclusive Growth. What I'm going to ask our panelists here to discuss a little bit is perhaps take quick 30 seconds. There may be some folks that don't know your organizations and perhaps where you sit within them. If you wouldn't mind, Bob, kicking us off, and then we'll go into our discussion.
Sure. So I guess being the one bank up here today, so Citi, most people know what Citi is, especially here in the Milken world. And as a bank that operates in 100+ countries, we long time looked at the issues of financial inclusion from going back many years, and it really began with the idea of how do you provide basic, what we thought of as almost parallel to banking services to people. So you began with microfinance, the Grameen Foundation, you would have heard of Professor Yunus and many others. It was an early stage of really how do you bring people into the financial services sector. And we began work in that area a long time ago. But some 10 years ago, we set up a group called Citi Microfinance, which eventually became Inclusive Finance, which is really what I lead now across Citigroup, the geographies, and with my colleagues in community development. But the goal has changed because the tools have also changed. I think we've taken now a much more interesting perspective that, one, it's not about just providing financial services in a kind of linear way or replicating how financial banks that we knew were doing it for many of us. But it really was the new tools of mobile and digital, and just realizing we were trying to find solutions for people's financial lives rather than only the institutions that were going to provide that. So it's a much broader set of organizations and institutes we work with today that really lead to financial inclusion.
Thank you. Tillman.
Thank you. The Omidyar Network is an impact investor started and funded by Pierre Omidyar, founder of eBay. In emerging markets, we seek to advance financial inclusion. In highly developed markets like the US, it's more around financial health. and I can say more about that. Maybe two quick comments that might be interesting to the audience. The first one, in emerging markets on the demand side, some 50% of working age adults are totally excluded today from the formal financial system. Very low bar, just having one account with somebody. So half of working age adults are excluded. That doesn't mean that they don't use financial services. They use the age-old mechanisms, moneylender, pawnbroker, rotating savings club. And these things can be very unreliable, very expensive. So what's required is new business models that reach far more people at far lower cost. And we bet some 5-6 years ago very much on the digitization of the retail financial services front end. And I can talk more about the portfolio later.
Great, thank you, thank you. Susan.
I am from the McKinsey Global Institute. We are the internal think tank of the global consulting firm. We're actually a fairly small but highly productive group. And our mandate is to look at long-term structural trends reshaping the global economy. In September, we released a report about digital financial inclusion called Digital Finance for All that brought together two different streams of research. One is we've been watching the evolution of global financial markets for many years, and also the impact of technology on economies and on development. And so in our research, we sought to be among the first to put really from a macro picture, what is the potential boost to GDP, how many people could be included, how much credit could be unlocked if you actually use digital means to profitably go further down the income pyramid and include more people, gather more savings, and thereby generate the capacity for more lending. And I'll talk a little bit about that.
Great. Daniel.
Hi, I'm Daniel Gorfine. I'm head of external affairs at On Deck and an adjunct fellow at the Milken Institute. Tragically, I'm a lawyer by background, but was fortunate a number of years ago to have joined the Milken Institute, where we helped to begin some of the work that the Institute's doing on expanding access to capital and really exploring the role that technology plays within existing or with traditional financial markets and services. So I joined On Deck at the end of 2014 to lead external affairs. For those who don't know, On Deck is one of the leading online small business lending platforms headquartered in the United States, but with operations in Australia and Canada as well. The platform is 100% focused on expanding small business access to capital and helping serve a public policy challenge, which is that the credit gap that I would argue had already existed for small businesses, but was certainly exacerbated post-financial crisis. So we use data, technology, and automation to build an efficient and scalable platform to help serve that segment, and look forward to joining the conversation today.
Great, great. Shamita, before you go, I'm going to actually ask you to take a little bit more time. So at the end of the day, financial products and services, they're not just, unto themselves what we're interested in. They are tools to address a much larger social impact element. So given the MasterCard Center for Inclusive Markets focus, I want you to orient us and actually ground us in what we really are here discussing.
Okay, great. My favorite thing, orienting and grounding. I think I can do that. It's really a pleasure to be here with the panelists and with you and the Milken Institute. My name is Shamita Singh, and I run the MasterCard Center for Inclusive Growth. It's a relatively new organization and an independent subsidiary of MasterCard Corporation that, unlike Citi, I don't think everybody knows knows of MasterCard, but may not know what MasterCard does at the end of the day, which is it's a technology that basically connects buyers and sellers. So it's the rails. It's not the bank. Citi is our client. Thank you, Citi. And we also work with retailers. So we're sort of the train tracks in the middle. If your train tracks in the middle, you see a lot of data going back and forth on those transaction rails. And you learn a lot about things like financial inclusion. So what the center is a place where we are leveraging MasterCard's assets, like data, like technology, like investment, so money, and most importantly, expertise around how people engage with the economy, and more importantly, how they buy and sell and have access to the economy. So it's the non-commercial side of MasterCard. So it's all about using all of those assets for social impact. But when you talk about financial inclusion in this regard, it's not the delta between the commercial and the non-commercial, and frankly, the doing well and doing good is not that far. I'm incredibly fortunate, frankly, to have a job where I sit very close to my colleagues on the commercial side, and at the same time, and my colleagues sit very close to me, and together we're figuring out what the intersection between commercial and non-commercial, and in our case, sustainable long-term growth profitability around a social impact solution, a social impact issue like financial inclusion. So it's an enormous opportunity. It's a great responsibility, but it's an amazing vantage point to be in. A little bit about financial inclusion, because you have probably the world's there's a lot of experts out there, but I would argue that this crew is pretty top notch, and so you're going to hear a lot about the promise and the productivity around financial inclusion. For me, I just want to put it in the context of the social issue and, frankly, the profitability issue. And so for us at MasterCard, why would MasterCard would even get in the space of something called financial inclusion, where essentially the opportunity is to connect somebody who may be completely disconnected in the financial services space, completely unbanked or partially unbanked, to some sort of formal financial transaction account. Why is that a big deal? It's a huge deal, because if you're operating in a cash economy, so if you're operating in an economy that doesn't allow you to store your money somewhere safe, so you're not putting it in the bottom of your bunk bed, or you're not putting it in some place where your husband or your sons or and I talk about it from the women's perspective, because primarily these are the ones who are the CFOs for their households, and these are the ones that are primarily excluded currently from the formal financial system. To enable that kind of productivity to be unlocked, where you no longer are trapped in an economy that only allows you to transact in your village, in your immediate vicinity, but actually allows you an opportunity to transact beyond where you live and where you immediately work, is everything. So for us who sit in this crowd and who are in the most connected economy in the world, the idea that you couldn't just pick up your phone and hit your Apple Pay or hit some sort of payment device and buy an airline ticket or buy the latest iTunes or go to the movies or do whatever you want, would never even think twice about it. For 2 billion people in the world, that is the last thing on their mind at this point. They have no ability to engage in the formal financial system. So they live in an informal economy that is rife with corruption, is rife with violence, and is rife, most importantly, with an inability to rise, no economic and social mobility. And what does this mean in terms of people who, like us, are working for banks and working for investment firms and working for Fintech organizations? It's an enormous growth opportunity. When last I checked, the last stats I saw were something in the neighborhood of $4 to $5 trillion worth of purchasing power among this population by 2020. So it's not a population that doesn't spend money. It's not a population that doesn't have money. It's a population that is disconnected from using their money in a way that allows them to move up the social impact strata. And so the people on this panel, and I'm sure many of you here, are either doing the work of making these connections happen, but they're also taking a step back to say, we're going to get there on financial inclusion. So the good news is there are 2 billion people who are currently disconnected, and probably close to double who are partially disconnected. And by partially disconnected, I mean, okay, great, I have an account, but I don't use it for anything, and I'm still doing all my stuff in cash. But what's happened is, because of the work of organizations like all of you, and interest from you, and people like Bob and Ible, frankly, who have been doing this longer than I've been. I could even spell financial. And so people who've been thinking about the microfinance space, and people who have been building the infrastructure to allow people to engage in the formal financial economy, gets us to a place where now we can say financial inclusion for what? So now the conversation, I think, is moving from everybody has to have access to an account. It's important for everybody to have a checking account or a credit card or an ability to engage on their mobile phone to do what? And that's the fabulous conversation in the fintech community. It's the to do what part that everybody's really interested in. Is it to purchase an airline ticket? Is it to get something out of your account? Is it to purchase medicine? Like, what is it that you're going to do now that you're included? That's the potential, and that's the productivity that I think is about to become unlocked. And boy, when it does, watch out, because if you think fintech has been interesting now, and you think it's a hot thing now, just wait till 2020, when all of the commitments between the World Bank, between MasterCard, between Citi, between other payment companies all stood up and basically said, we'll include 500 million people by 2020 and 40 million merchants, but everybody else did too. So there's actually a path forward to reach full financial inclusion by 2020.
Yeah.
I'll stop there.
No, thank you for that. And I think you hit it right on the head, that we're not just talking, again, about just the consumption side of things. It's that productive side of things. But at the end of the day, when we say financial inclusion, there's obviously something happened. There was an exclusion. And not necessarily from Citi's perspective, let's say your competitors that got it wrong. Given Citi being one of the largest financial institutions in the world, you provide a very unique perspective with regards to what traditional players should be doing, and it would be great to hear what Citi's been doing, pushing the envelope in this area.
I think the perspective I gained was, before doing this, I was the senior risk officer for Treasury at Citi, and then in regional treasurers around Africa and the Middle East and elsewhere. So my grounding also was, Citi is in Bangladesh too. There's a city in Chittagong where microfinance began, or this happens to be one in the Congo or in wherever, Paraguay. I realized as we looked more and more that we were really only serving as an industry, a very small part of the real economy. And it was the interesting entrepreneurship we saw below that caught all of our attention. And I think those who've also taken that very much forward are some of the most innovative local financial institutions. And if we're talking the banking sector just for a moment, who've really understood that the bulk of the majority of their population were waiting to be served. And as Shamina said, what has also become more apparent is it's not about being served by only a bank or by a card company, payments company, or an online platform. It's about the integration of those around a package of solutions. It's really, what are you trying to do, and what are you trying to do differently that can be more productive and can be done at a lower cost? And that's resulted in our finding ourselves and others collaborating much, much more with other institutions and different kinds of providers of financial services. So we think of, as I'm here with one of my colleagues, and we think about some of our largest corporate clients, global clients, deal with some of the smallest businesses in rural and urban areas in the countries in the emerging markets particularly, who are completely outside the financial sector. They're looking for solutions. They're looking for payment solutions. They're looking for those small businesses to be banked or to be serviced or to have an online access. And what has become so interesting in this space is where this comes together. If you really think about what is it that you add value for someone, or a household, or a small business, it's going to take, and it can be very interesting by combining the providers. And increasingly, the work we do will be with fintech companies. It's clearly with the MasterCards of the world, because I think we're the largest issuer of MasterCard in the world. So with the innovation that MasterCard comes up with, will serve our clients as well. And those platforms that can provide credit beyond where the banks are doing today, either because of expertise, or banks have Basel III and many other constraints that may make it less attractive, well, they can be also part of a solution for our clients too. And just as we would access markets for our clients, can we in the future be accessing all sorts of other funding platforms? And so when you think about markets in that broader sense, and so and the same with mobile operators and other forms of providers. So I think what we find now is, as Shamina said very rightly, if you focus on need and where you can increase productivity, safety, efficiency, bring down costs for either it's a household or a business, there's the opportunity to be innovative and bring people into the system. And governments, I must say, play an important part of this too. Yep. Governments are huge spenders of money and dispersers of funds and collectors. And the more many of us have worked together, actually a couple of us here, on things such as Better Than Cash Alliance, how do we get them to go digital? Because if you can get some kickstarts to these new technologies by getting governments to move their funding, their payments, their pensions and salaries, their collecting of fees and revenues online, you really can create the volume that will help underpin a lot of the markets that are in development.
Yeah. No, thank you for that. Now, clearly, Citi, MasterCard, two well-known brands. We heard a little bit about essentially the evolution that's happening with regards to the fintech landscape. And there are a lot of exciting things there. Clearly, at every one of these Milken Institute events, there's a silver lining we'd like to talk about. There is a new name with regards to fintech and a lot of new players out there. Daniel, it would be great to hear from your perspective what, as a new player in this landscape, new relative to the long history of MasterCard brand and the Citi brand, what your perspectives are.
Well, we've been around for 10 years, so in fintech world, dog years, that's a lot of years. But no, I think, as we're talking about it, you can divide up the fintech world into a few different verticals. There's payments platforms, there's currencies and electronic currency platforms and means of transferring money, and then you have lending platforms. So certainly from an on-deck perspective, that's where we fit. But I think there's a lot of commonalities across these. So let me kind of lay out what I think, at least in the online lending space, are three value propositions that are, I think, equally relevant to developed markets as they are to developing markets, and in fact might even be more relevant to certain developing markets. So three things you get from technology in the context of credit. There's automation and scale, there's the use of data, and then there's the user and customer experience and how folks access financial services. So the first piece, when I talk about automation and scale, when you look from a developed market perspective, post-financial crisis, we did see traditional banks further retreat from kind of the smaller sized lending to Main Street merchants, if you will. So in the United States, that would be loans of under $250,000. You've seen the same dynamic somewhat replicate itself elsewhere around the world, and that's because the cost of traditional processes and the cost of manual underwriting processes is quite expensive, which explains why you're going to see it very difficult for a traditional process to serve certain segments, especially smaller merchants. If you're able to use data and technology and automation to speed up the underwriting process and build a scalable platform that can do this at volume, you can, in an efficient way and in an economically viable way, help to serve that segment. The second piece around data, one of the insights that we had on deck was that perhaps personal credit is not the best proxy for the health or performance of a merchant or a small business. So looking at data to underwrite a small business can be a way to expand access to credit. You're seeing a lot of innovation around that as well overseas, where folks are looking at alternative sources of data to underwrite folks that otherwise would not be able to access credit. The third proposition is around where are you meeting your customer? Reality is that more and more people are looking to engage in financial services through the internet and through mobile. And so that's where fintech companies are focused. And certainly overseas, if you're trying to leapfrog the lack of traditional infrastructure in emerging markets, you'll see the ability to use mobile, use the internet to leapfrog that lack of infrastructure in order to provide these types of services. So it's a really exciting time, and the last thing I'll just end with, and we can go into more detail later, is the possibility of partnering between fintech and traditional financial services companies in order to unlock that type of financial opportunity for customers. We do that in the US with JPMorgan Chase, where they license our platform to help serve a segment of their small business customer set, and you can certainly see the space evolving that way into the future.
Yeah, no, that's interesting, whether it be a traditional player or a fintech player, new or 10 years old. At the end of the day, the target seems rather similar in my mind. Tillman, Omidyar Network is just not necessarily just a player in this space. It's actually a facilitator, an investor to bring other organizations to the landscape. It'd be great to hear from your perspective how you see, essentially, where do you see some of the scalable solutions coming from?
Yeah, thank you. So first I say, you won't get much disagreement up on this panel. Sorry about that. So
we should have got, a dissenting person that believes we need to have more.
I agree with Shamina and Bob that there is latent demand, big time. But it's teeny tiny ticket sizes. That's important to realize. And I agree with Dan that fintech is a solution here. And that's because technology-led innovation allows to address that demand and in a viable fashion. So let me give you 2-3 examples, and then I also speak about sort of the broader ecosystem that has to come together. So, for example, so we recognized the power of the mobile phone some 4, 5, even 6, 7 years ago, right? The mobile phone as the one device that is penetrating emerging markets more than anything else. And you all have heard these statistics. More people now have mobile phones than they have toothbrushes and stuff like that. By 2020, 80% of working age adults will have smartphones. And what that means is on the credit side, for example, estimated billion people out there who don't have a FICO score, but they have a digital footprint that is quite predictive from a credit perspective. So the fact that I'm moving every morning from A to B and then back in the evening from B to A seems to suggest that I have a regular job and I have a home to which I return, even though I don't have a W-2 and I don't have a land title or an address, but this information is there. So there are a number of people who are exploring this type of information. We have invested against that using either CDR data, social media data, or even generating sort of psychological profiles. Same on the savings side, right? Poor people, contrary to belief, actually do want to save. It's just very tough. Yeah. With the mobile channel, mobile money, with the digital channel, you can collect high frequency, small denomination savings. Microinsurance. Small life insurance, accidental death and dismemberment, even health now, first dollar health coverage can be provided via the mobile phone. Micro-leasing of residential solar units. Shamina, that links right to a very tangible benefit to the family, right? In East Africa, some 80% of folks are not on the electricity grid. They burn kerosene at night so the kids can study. Kerosene is unhealthy, it's expensive. For the same, actually for less than the daily payment, they can own over a year the residential solar unit. So there's a micro-leasing finance innovation that was waiting here. None of what I just described, all of these things I described do exist in East Africa, in India, in Southeast Asia, in parts of Latin America. None of them would have been viable without the digital channel, because you can't process a 20-cent payment if it costs you on average $1 in the cash-based brick-and-mortar environment. And now financial services are regulated for good reasons. We can all argue to what degree it should or should not be, but it is regulated, and that will not change. And so a broader ecosystem has to come together, and government plays a big role both as a provider of infrastructure. So for example, digital ID, universal digital ID is a big deal, and India is pushing that, as you may know. 1 billion people registered, 10 fingerprints, 2 iris scans. Government is, of course, a regulator and should ensure an open API type environment, so there's a level playing field. And government is a user. So again, now governments around the world are switching from their social transfer payments that often used to be still in kind, right? A bag of fertilizers. They're switching it straight from in kind, not just to cash, but to electronic payments. And that reduces the leakage and the corruption in the system that Shamina alluded to. So a lot is possible, and I'm sure Susan will talk more about that, because these guys size the price,
the opportunity.
So to speak, yeah.
No, that's a perfect segue. And actually, we just heard about a range of the issues, the opportunities, and different things that are going on. Clearly, MGI and McKinsey itself is at the forefront of thinking through how to understand what we just heard. And actually, would you mind even providing a little bit around the takeaways that you would want folks to walk away with?
Yeah, Tillman, that was perfect. Now I'll tell you all the big numbers behind the various opportunities that Tillman said. So, I mean, I think the big thing I would want people to walk away with is this is an opportunity that can happen today. It's an opportunity for emerging economies to go from being unbanked, cash-based economies to being far more advanced in terms of digital payments and banking and inclusion than the United States, where I live, is today. And the infrastructure is there. Yes, cell phone coverage is not perfect. A lot of people don't have smartphones today, dumb phones. But just given the state of wireless coverage today, which covers 80% of the population in the developing world, and you've got nearly 80% of adults have access to a mobile phone, we think that you can include 1.6 billion adults today. It's feasible because the average cost, give or take, for a bank to provide a traditional account with brick and mortar branches and ATM machines is on average about $100 a year. That's what it costs the bank to actually provide those services. If you go to a purely digital scenario based largely on the mobile phone, as Tillman said, the average cost is about $10 a year. That's a 90% saving. And if you're only spending $10 a year, then you can bank people, provide services to people at lower income who have lower balances are going to store with you. They're going to transact in very small amounts, but the marginal cost of processing a digital payment compared to the cash being passed from me to the store, to the bank, to the next bank is more than 90% lower. So this is profitable. It's possible now. 1.6 billion people could get accounts. Now, on the other side of the ledger, why do we care? This panel started to get into, it's not just giving someone an account, it's giving them a safe place to store the money that they are saving, but they're keeping it in cash, or they're buying physical assets, or they're using other informal village-based savings mechanisms. We estimate, just looking at national central bank balance sheets, that there's $4 trillion in cash and household physical savings that could over time migrate into the financial system. So for the bankers in the audience, that is a big number of potential deposit gathering. And of course, once you have the deposits, you can make loans, in part because of what Tillman talked about with now that if small businesses have digital payments, they suddenly have a track record of their sales, of their expenditures, of their receipts, and financial service providers can use new ways to give them credit scores. So once you've gathered the deposits, you can unlock credit for many more small businesses. Now, I spend a good deal of my life warning about debt. So I must say that we impose very strict leverage limits on the potential to grow credit, both for the banking system and for the borrowers. But easily you can get over $2 trillion of new credit without exceeding very conservative leverage limits. So it's a huge opportunity. And it's, I think that, Mark, you started out by saying that this is a fundamental transformation of how these economies operate. This isn't just about inclusion. This is like electricity in the economy, that having a digital, widespread, efficient payment system is just underpins all types of economic activity. And it's possible today.
Yeah, no, thank you. Now, we've got a couple of minutes here, and I wanted to open it up to the audience to ask a few questions. Why don't we get some microphones that should be circulating? And if not, we can hear your voice. Why don't you stand?
So Damien Lee, IQ Super. So look, I'm really excited about the opportunity set. To me, it's the great hope of growth in the economy over the next decade. However, my understanding is in places like Brazil and Mexico, a lot of people are happy to be outside the system because if they're inside the system, they've got to pay tax. And so I wonder, I think Tim mentioned about governments need to get involved. Is there an advocacy or is there, how do you get...
how do you get governments to provide incentives to unlock this opportunity?
Sure.
I just, as you mentioned Mexico too, and I always remind people, people think of city only in America, and global, but we have twice as many branches in Mexico as we do the whole of the United States, so it's a big market for us. And there are governments like Mexico and many others that people along this table have worked with, forum, that are very, very purposefully coming out with national agendas and strategies for financial inclusion, but they're real. They're more than policy discussions. They're looking in countries like Mexico at creating a sandbox, for fintech firms. They're truly doing an analysis of their own regulations and saying what would inhibit innovation. we know with the bank there that they're asking the questions, what are you doing in terms of opening, not just of new accounts, which was an old way that central bankers used to do it. They would say to, I remember that in India and elsewhere, well, the banks to open 1 million accounts, they opened 1 million accounts, and as Shamina said, they were dormant. But really looking at the link between the financial institutions that are there today, which hold a lot of the capital, but also these other services. And how do you build in the way people are today transacting and just help add value that makes it more effective? And I think a lot of that is coming partly through the payments window as a starting point.
Yeah.
You're really adding an efficiency to it. So whether it's governments such as Mexico, or I think of Indonesia is looking at this, certainly Philippines has, Pakistan, India, it's much more granular than it was before. And it is about reforming regulations and opening up from what were traditionally very siloed ministries of telecommunications, of banking, and that's very exciting. But I would say some of the countries are moving much quicker than we found was the case even in countries such as the United States, where these traditional regulatory boundaries are taking a lot to cross over.
Yeah.
Yeah, on the I think it's worth repeating this point around the demand is there because it's in the informal economy, and whatever we offer collectively has to be better than the informal alternative. And you are right that there is a calculus around moving from informal to formal has other costs associated with that. So that is a reality that we can't deny. It seems though as if the new environment that Susan described and Shamina described earlier and Dan illustrated, that it can create very, very superior value propositions. And Bob mentioned the 60 countries around the globe who have made a financial inclusion commitment in the context of broader formalizing the economy. The most interesting place without any doubt right now is India, and for two reasons. The first is India has put together what people call the India Stack. And it's really a set of platforms on top of platforms, open API at each stage, which makes it a very low-cost environment. At the base is the unique ID that I already mentioned. The regulators are allowing for eKYC now, so the unique identity number is good enough for KYC purposes. The banks own the National Payment Corporation of India, which has created an open API type environment. And I can literally send from @Tillman to @Susan money for cents on the $1,000 transaction. And the system figures out it's from a regulated account to a regulated account. All of that is taken care of. And India is so confident in this, as you may have read, that it demonetized recently and basically outlawed the old $500 and $1,000 rupee notes. That's a pretty radical step, and that's logistically tough, but governments want to push this, and I believe they have to provide the environment that is conducive to provide better value proposition. So much better that it's worth switching.
Yeah, let me give you a different example. So India is one example. Ban what is the equivalent of, in US dollars, like $10 and $20 notes. In Mexico, I think so in many countries, Mexico is one of them, many of the government subsidies now go to people in digital means. But what's happening is people go to the ATM machine, they withdraw the entire amount in cash and then go spend the cash. So the next horizon is actually how do you get people to keep money in the account and then pay for things digitally as needed. And there what you need is small stores to accept either card payments or phone-based digital wallet payments. So there's a Fintech startup actually based in Sweden that has created a smartphone-based way of accepting payments. It's called Zettle. And on top of that, once it takes the payments, it spits out like automated financial reports for the small shops, so they can see what are their sales of this type of good on Monday versus Friday, and they can keep track of what they need to reorder. So I think to Tillman's point, once you get benefits like these, so it's not just, well, if I take digital payments now I have to pay the VAT tax. Well, I don't have any incentive to do that if my customers aren't demanding it. But if they see that automating this actually saves them time and money in reordering and understanding their business, and then maybe improving sales because they understand what's selling to whom, when, then I think there's incentives to overcome this tax hurdle of being informal versus going to digital.
Let me play devil's advocate here, because I do believe there's quite a lot of innovations, but that there's the other side of that. There's the other side of going so far to the point where we're putting folks at risk in terms of whether it be too much inclusion in the form of debt, labeling a lot of specifically bottom of the pyramid individuals to have too much lending attached to them, or consumer protection risks, or regulatory compliance. So there is the extreme end, and I'd love the panelists to talk a little bit about all of these things. Or
I'd say, look, it's a problem. There are stories in East Africa of now digital money lenders. So person-to-person transfers that have the same problem. You can prey on a vulnerable person who doesn't understand that a 5% weekly interest rate is exorbitant, and they can't afford to take that loan. So, and the problem with digital is now it's not only a money lender that you can see, you can be, giving these person-to-person loans to strangers over the internet. So the scale of potential fraud is opened up. And it's something that regulators need to worry about, and certainly financial literacy on the part of users is very important.
Yeah, I would definitely agree with that. I mean, one of the keys with all fintech innovation is you want to make sure that these are tools that are going to be utilized by individuals, and you want to make sure folks understand how and why they're using certain products or services. So, one example that On Deck led in the United States, along with a couple of other large platforms, was to create a model loan disclosure that would essentially standardize the types of pricing metrics with explanations and calculations in a standardized way that can cut across the range of product offerings that are in the market. I mean, one of the things with fintech, and I think this is net a positive thing, is that there are these different products out there, whether they're cash advances or loans or lines of credit. But if they're described differently, it can be challenging to fully assess and compare across products. So to the extent you can drive standardization and make sure disclosure is clear so that the product fits the use case, that's critical. Actually, the Milken Institute does a program with the IFC and GW University with international regulators and policymakers, and one was recently noting, I think, this example in Kenya, where you're having that problem of products being offered without kind of clear explanation as to how they work. And if you end up with the wrong fit, or it's not for the right use case, you will have bad outcomes.
yeah.
So if a policymaker has 4 objectives when it comes to the financial system, stability, traditionally stability, consumer protection, integrity, and now financial inclusion. Many have embraced that.
Yep.
If you look at this pairwise, in many cases, fintech is good for the policy objectives. So a broader retail deposit base is good for stability. More payments captured by the formal payment system is good from an integrity, anti-money laundering, combating terrorism finance perspective. So the one issue indeed is credit and the consumer protection side.
Yeah.
And the problem there is that often individual lenders don't know that households have credit elsewhere. And so that led to microcredit crises, and that can well lead to digital short-term credit crises. But then the digital world also allows for better sharing of this type of data, and therefore regulatory management of the risk.
Yeah, yeah. I think we had a few more questions.
Hi. I was just wondering, for Africa, I mean, on medicines, for example, you've got these, WHO or, the EMEA, they all work together for international standards. I mean, obviously everyone uses medicines, in Africa, but I mean, on finance, it's not so clear because you've got the big banks, Barclays or wherever, but then for all this FinTech stuff, from what we can see, I mean, apart from like M-Pesa, it's just like the Wild West out there. So where do you see it going in terms of regulation where there's minimum standards or sharing across instead of each country having to reinvent the rules and their own standards, like for East Africa versus West Africa?
Well, I think that there's an organization called the Alliance for Financial Inclusion that was created for precisely that purpose, which is to aggregate all of the central bankers from all of the developing markets and bring them together and figure out the regulatory requirements in such a way that nobody has to do it by themselves. And so they've actually spent several years working together on common regulatory frameworks. But
Yeah.
Yeah, they're the central bankers of their countries.
Yeah.
And so, yeah.
You know, the one point I would add to that is, look, an increasingly internet-based economy doesn't recognize traditional geographic boundaries. So I think it puts an even greater urgent need on standardization and harmonizing. It's something that in the United States we grapple with at the local level, where we deal with individual state regulation, overlay of federal laws. Trying to harmonize just that jurisdiction is challenging enough, but then when you kind of think about this on a more global scale, which makes sense since platforms can scale internationally, it does make sense to work towards harmonization. So any types of bodies that are thinking about this, you want to create baseline rules that make sense across jurisdictions and that make sense for technology platforms as well, so you don't have odd idiosyncrasies between different jurisdictions that may not serve a regulatory objective and certainly aren't efficient from an industry perspective.
So the issue of interoperability that you are asking about, that's a big one. And you could argue, obviously in Kenya, mobile money M-Pesa wasn't and still is not interoperable, and it didn't need to be because you had a dominant operator. And maybe we needed that to prove this new concept. But others are watching this very carefully. And in Tanzania, neighboring, there are 4 network operators. They all provide mobile money, and they have agreed on interoperability among themselves. And guess what? Transaction costs in Tanzania are quite a bit lower. And now a next generation of countries and regulators are leapfrogging all this. So in Peru, the entire ecosystem came together to create sort of a low-cost retail payment, digital retail payment infrastructure. Myanmar is totally leapfrogging. It's this one place where mobile telephony, mobile money are being introduced roughly at the same time. That's a historical accident because the country opened only recently. And they we helped them, right? They did study tours and they came up with a good regulatory framework. And they leapfrogged straight to 3G, all smuggled in from China.
Interesting. So we have a few minutes left, so I'm going to ask if we take maybe 2 or 3 at the same time. I think we have a question right here in the middle.
You haven't talked today about blockchain or Bitcoin, given its low cost. You haven't talked about Bitcoin or blockchain in this process, much cheaper than typical bank transfers.
Should we take one more, or? Okay. Who would like to take that? And I want you to talk about it within the context of what you were doing a little bit before earlier.
Yeah, so Bitcoin is obviously an interesting concept. In particular, the public ledger is a really, really interesting concept. To be honest, in the financial inclusion, emerging market, domestic scenario that we are talking about, it's not needed, right? And it's not the technology that will make the big difference. It might be a technology for remittances if you have to back-to-back payments. But even there, frankly, the fact that remittances in many corridors are outrageously expensive, it has a bit to do with cash in and cash out, which you can't squeeze unless everybody is digital. And then it is the banks in the middle that charge what they can. And the challenges to all of that, the world remits of the world, the transfer wises, they are driving down remittances costs without relying on Bitcoin.
And I think there's always a challenge, at least in the early stage, of trust. There's a confidence level. People are moving from cash, which was real in their mind, to even to digital being a debit card, a credit account, a mobile payment. It's a big transition. And we see it, I think Shamin said it before, when people, many even in the US where we have programs, are first being put onto their bank account or are using prepaid cards as an alternative to cash, there's a real tendency to take all the cash out at once. There's always the concern, is it really, is it available there? What will be the costs each time I take it? There's really been, if you look about where people see the advantage, as they get familiar, we'll be able to introduce more and more. And people do leapfrog. But there's a process here also of trust. And a lot of these, if not understood well and not experienced well, it's a big setback. And so we're really moving out of cash, physical cash in many cases. And that first step, maybe Bitcoin will add that value in time. But right now, trying to assure them that what's on that card is what was in your hand before, just stored somewhere else.
This point around distributed ledger technology is really an interesting one in my mind. So I would say in many parts of the world, real assets, essentially real estate assets, was pretty much a bedrock for the development of capital markets. And in a lot of the developing world, you had completely a misunderstanding of who sat on what parcel of land and who actually had it, and then somebody would move for 5 minutes and somebody else would claim that they had now rights to it. Distributed ledger technology offers a really interesting perspective on who actually owns that land, who owns it, transfers it to other individuals. That really starts to open up essentially a much more modern collateral asset registries that are huge potentials. There's 2 test cases that I believe are going on right now, one in Peru and one in Kazakhstan, where they've actually gone into very low-income neighborhoods and are trying to apply that technology to create an online collateral asset registries, and what that might actually translate to in terms of providing that collateral as a groundation to providing other financial products and services that these populations can have access to. It's going to be an interesting thing. We don't know what the results are going to be, but these tests are out there.
I mean, I would say, look, if we're all here in 2 years, we probably will be talking about blockchain. Not Bitcoin, which I think is a fringe thing. That's my own personal view. I think a lot of the use of Bitcoin today is precisely the same people who had the 1,000 rupee notes are using Bitcoin. A lot of it is capital flight. So Bitcoin's a fringe, but the blockchain technology, I think, does have uses, but it's also, I think it's a couple years away, at least in emerging economies, not least because of the types of internet connections you need to make that work. And the promise of that we're talking about digital payments today through 2G dumb phones. I'm not sure how that applies to blockchain, but I know that there's just a ton of money going into innovating with blockchain, and in a couple years we may be talking about how that applies to the emerging world, whereas today we're mainly talking about how it's transforming Western Europe, US, developed nations.
Yeah. So I'm going to take moderator's prerogative, and I want a lightning round question that I want folks to walk away in thinking about. On this side, I want folks to take 30 seconds and describe what's the consequence of getting this wrong.
Okay, I'll take a start. The consequence of getting it wrong is that you end up worse off than you are today, because you've created a mini household credit bubble, you've indebted people, you've turned them off of trusting digital payments and digital banking, and you still have not achieved financial inclusion. You have mid-market and the small companies are outside the financial system largely. So you're in the same place, but you've actually now eroded trust, indebted people, and created a small banking crisis.
I agree with that. I mean, the only thing I would add is that it's hard to say you're going to get it wrong, because it seems to be where the future needs to move, and it's the way that you do bring in millions, if not billions, of people into the financial system. I actually think that it's more likely that policymakers aren't forward-looking enough to understand that's where we're going. If you ask yourself in 5 years, are we more or less likely to have mobile drive financial services and transactions? I think the answer is clear. So good policy, and Tillman mentioned before, and I think it's so important, that e-identity piece, policies that recognize that's where we're moving, so make it viable for an individual to have a digital identity, because that's what unlocks all of these services that we're talking about. That's the kind of forward-looking policy you need. So I think it's more, make sure you don't muck up the frameworks to make sure that we do get where we seem to inevitably be going.
I think if you get it wrong, you get anonymity for all the wrong reasons. So you end up with people off the grid, because the ability to be on the grid is there. And if they're not on the grid, they're off the grid for a very particular reason. And so you end up with anonymity for the wrong reasons, and I end up with something even worse than income inequality. You get the gap between information inequality. And you end up in a situation where data and data analytics and the power of data is held by a certain sector of the economy, and not realized by the other sector of the economy.
Just because I want to end on a little bit more positive note,
Yeah.
define success for you.
I think in 5 to 10 years we will have a number of countries who have embraced some sort of smart nation concept, where the right digital infrastructure is in place with the right open APIs, etc., the right regulation, and this could be the Singapores, the Rwandas, the Perus, who knows, maybe even the Myanmars of the world. And what will happen is that you can compete by leveraging all that infrastructure, have a much, as a private sector provider, you have a much lower cost base, you can variabilize a lot of cost, and we can see competition at the level of customer value propositions that are much more in sync with how we all deal with money rather than the supply-side product silos, because we all think in terms of mental accounts, right? Day-to-day cash flow management, savings for a trip, savings for the kids' education. And technology can help us do a lot in managing the way we actually like to manage our money, rather than how we have historically thought as an industry it should be done.
Final word.
I think if we have a feeling of success will really be that, particularly in households around the world that we're talking about, they'll have a lot more control over their funds. They'll pay a lot less in fees. They'll get more efficiency even for what they do today, much more productivity. I think that was said before too. You can think about the ability to really manage your funds so much more efficiently that all of us try to do. What a difference it will be taking people out of a cash, often abusive financial economy into one that they really are empowered to make decisions and execute at much lower cost. I think everything from remittances to payments to credit could put a lot of money back into a household, which is a real stimulant to the way, because most of these households are going to spend that money in the end too on goods and services they really they need, and their children and their family need. So I think it's an empowerment.
Given the context, that's what's going on again on both sides of the pond. This inclusion is a relative point, a very important point. So with that, I want to say thank you to our panelists today for a great discussion and for the audience for some great questions. Thank you.
Thank you.